Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. CMQ investors, welcome to the show. It's great to have you here. If you listen to episode 15, well, this episode is in many ways a continuation. If you haven't listened to episode 15, I highly recommend you go back and you listen to that first, because I think you'll get more out of this episode if you do. We are about to explore how being a long-term thinker and having a long time horizon as an investor allowed Warren Buffett to take a completely different view of risk. And Warren Buffett's alternative perspective about risk gave him a competitive advantage. Let's figure out why. Much of Wall Street would tell you that the riskiness of an investment is measured by something called beta, or the beta factor. Warren Buffett describes beta as a Wall Street term often used in measuring risk. If you're using beta as your calculation of risk, well, through that perspective, through that lens, risk equals volatility. Remember that. Risk equals volatility. Warren Buffett fundamentally disagreed with this idea. In 2011, Warren Buffett said that the riskiness of an investment is not measured by beta, but rather by the reasoned probability of that investment causing its owner a loss of purchasing power over his or her contemplated holding period. In layman's terms, when he says loss of purchasing power, Buffett means you lose your money and you can't get it back. In 2018, Buffett said that investing is an activity in which consumption today is foregone in an attempt to allow greater consumption at a later date. Risk is the possibility that this objective won't be attained. Now, that all makes enough sense, right? That seems to be very logical, very reasonable. Seems to be a rational way to look at risk. But it was not the consensus view. And the reason for that has to do with time horizons. The following comes from Robert Hagstrom's excellent book, The Warren Buffett Portfolio. And I quote, "For Warren Buffett, risk is inextricably linked to an investor's time horizon. If you buy a stock today with the intention of selling it tomorrow, then you've entered into a risky transaction. The odds of predicting whether share prices will be up or down in a short period are no greater than the odds of predicting the toss of a coin. You will lose half of the time. However, says Buffett, if you extend your time horizon out to several years, the probability of its being a risky transaction declines meaningfully, assuming, of course, that you've made a sensible purchase. If you ask me to assess the risk of buying Coca-Cola this morning and selling it tomorrow," Buffett says, "I'd say that that's a very risky transaction." But in Buffett's way of thinking, buying Coca-Cola this morning and holding it for 10 years carries zero risk. Now compare that quote to a quote that we cited in our last episode from Jeff Bezos. Bezos said that if everything you do needs to work on a 3-year time horizon, then you're competing against a lot of people. But if you're willing to invest on a 7-year time horizon, you're now competing against a fraction of those people, because very few companies are willing to do that. Just by lengthening the time horizon, you can engage in endeavors that you could never otherwise pursue. Just by lengthening the time horizon, you can engage in endeavors that you could never otherwise pursue. Now, think about a money manager who's dealing with clients that are very emotional, that are calling him or her every time the stock market drops or their portfolio value goes down in the short term.
Hey, Jeff, I just took a look at my portfolio. Looks like we're down 6% today. Let me just give you a fair warning. If you don't fix these numbers, you're going to be down 6. Not 6%, 6 feet.
Investors with a long time horizon, like Warren Buffett, have a competitive advantage over that kind of investor. In his 1995 letter to Berkshire Hathaway shareholders, Warren Buffett wrote the following, quote, "We will get hit from time to time with large losses. Charlie and I, however, are quite willing to accept relatively volatile results in exchange for better long-term earnings. Since most managers opt for smoothness, we are left with a competitive advantage that we try to maximize. In other words, we prefer the lumpy 15% to a smooth 12%. In another letter to shareholders, this time from the early 2000s, Buffett writes, and I quote again, "The declines make no difference to us, given that we expect all of our businesses to now and then have ups and downs. We don't care about the bumps. What matters are the overall results." But the decisions of other people are sometimes affected by the near-term outlook, which can both spur sellers and temper the enthusiasm of purchasers who might otherwise compete with us.
Jeff, it's me again. It's funny because you asked me if I could deal with the bumps, and can you deal with the bumps? The bumps I'm gonna put on your head when I give you the beating of your lifetime, buddy, okay? You better call me back.
I have one more quote from Warren Buffett. Volatility is not a measure of risk. Risk comes from the nature of certain kinds of businesses. It can be risky to be in some businesses just by the simple economics of the type of business you're in, and it comes from not knowing what you're doing. And if you understand the economics of the business in which you are engaged, and you know the people with whom you're doing business, and you know the price you pay is sensible, you don't run any real risk. And that's a great reminder. Just because you're a long-term thinker, just because you have a long time horizon, doesn't mean you're going to get great results as an investor. There are certain things you have to do right, no matter what your time horizon. And one of those things is getting the price right. To get a better understanding of this concept, listen to episode number 8 of Compound Money Quietly. It's called How Overvalued Stocks Kill Your Compound Returns. Now, before we conclude the episode, I want to thank all of you who've left a written review via Apple Podcasts. If you're listening through Apple Podcasts and you haven't had a chance to leave a written review, please consider doing so. It goes a long way, and as I've said before and I'll say again, I really appreciate the reviews and I enjoy reading them. Since we haven't heard directly from Charlie Munger in this podcast, and being that this podcast would not exist if it were not for our Instagram page, @CharlieMungerQuotes, I think it's only right that we conclude with a quote from Charlie Munger. This is what Charlie Munger had to say about beta. Quote, "Volatility as a measure of risk is nuts. Risk, to us, is the risk of permanent loss of capital, or the risk of inadequate return." Charlie Munger also says the best thing a human being can do is help another human being know more. If you learned something in this episode, make sure you share it with a friend. I'm sure they'll appreciate it. I will also appreciate it because you sharing this content is the best way for it to grow, and it's the best way for us to continue spreading wisdom about investing. Wisdom that we can learn from, wisdom that hopefully we can use. Now, with all that being said, I also want to remind you that we have a newsletter which you can subscribe to totally for free at cmqinvesting.substack.com. You can also access it by going directly to cmqinvesting.com. Our free subscribers receive updates in their inbox every time a new episode is released, and the updates contain notes about the episode. If you want to dive deeper, if you want to see some of these quotes, sometimes I share things that didn't fit in the episode that you can also learn from. So cmqinvesting.substack.com. Once again, my name is Chris Franco. This is Compound Money Quietly, the CMQ Investing Podcast. Thank you again for listening. We'll talk to you soon.